think as well, in the past, like if you look over 2010 to 2020, it was an incredible, like you said, we're no longer in this period where they can just come and save us with low rates and QE anymore. That's gone now. That decade, that extraordinary decade we had of tech growth and high beta stock growth, it's past us now, and I don't know where we go from here now. Can they still do QE in the same way they did it before? Is it going to be a new iteration of it? You've got the ECB talking about that now. They're going to introduce this new tool. No one knows what it is yet, but I have a feeling it's going to involve some sort of QE.
So today's episode of 25 on 5, I'm with Dilen from Macro IQ. We're going to be discussing the current macroeconomic outlook, and we'll also talk about DeFi and DeFi Ponzi's, Bitcoin, and everything that's going on in the world economy right now. We're live, so welcome 25 on 5. Welcome to the podcast, Dilen. You're no stranger here anyway. We've got a 25-minute hard stop today, so we're going to get straight into it. I'd love to know your thoughts on the current UK economy. Mr. Macro IQ, definitely want to get your thoughts. What's your current thoughts, and what do you anticipate over the next 12 to 24 months?
In the UK economy, I think if you look at kind of economies around the world, particularly the US, the UK and Europe, the UK is probably in the worst state possible at the moment. Inflation is running out of control, much higher than you've got in the US and Europe. The cost of living crisis has become like a mainstream kind of news narrative now as well. We're definitely we're running into a bit of trouble here in the UK, I think, and it's going to be a lot more difficult for the Bank of England to try and deal with that as opposed to the Fed and Europe. One thing I always say about England and the UK in a lot of my articles that I've been writing recently is the UK is a crystal ball for America and Europe, because they started tightening a lot quicker and a lot earlier than America and Europe did. So for America and Europe, 6 months, 12 months down the line, they're going to be in the exact same position. So for the UK economy, I'm anticipating a recession, as I am everywhere in most economies, but the UK are going to get there a lot faster. The OECD, I believe it is, they came out with a report last month, and they said next year growth in the UK is going to be worst. Is going to be the worst out of all the major economies in the world. So I'm expecting the UK to be pretty bad. I need to try and get out of here as quick as possible, I think.
Yeah. So I feel that some of the indicators people miss are some of the most common sense indicators, right? Even when you start to see a few months ago, we see Netflix, FedEx, Tiffany and Co. all miss on earnings, right? And when people started to forecast economic deceleration, and we start to first hear about it, I think a lot of people was very optimistic. And when you see the FOMC meetings, and people do get optimistic in markets, which of course you are, right? But I also feel that the sort of behavioral finance aspect comes in then, and people look for biases. They're looking, and we can find them online, right? It's easy to find a bias that suits your personal narrative, right? Anyone
just
can
scroll
do it.
on Twitter for 15 minutes, mate, and you'll find something.
Yeah, well, look, these platforms are set up. The algorithms are going to show us what we want to see, so it's not hard to find. But everything that has been going on, and all the optimism that it has been in the market. Recently we've heard some of the comments from Jerome Powell, and people have started to realise that okay, we need to start taking this a little bit more serious, because he's not really.
He's not messing around.
No, the confidence isn't there anymore either. So we've heard him say quite recently that he's open to potentially another reserve currency, which we've never ever heard the Americans talk anything about that. So and we're also heard him say that look, we don't really know what to expect because the world has changed in the last 2 years. Then we've had Jamie Dimon say the same thing. Who knows where this is going to end, because we never experienced this before. So a lot of uncertainty in the market from some quite key voices as well. So the other thing I want to ask you was this whole soft landing that we're
soft-ish landing.
Yeah, well, people are talking about a soft landing, and I've tried to look back through some of the historical data, and the Fed never creates a soft landing. So very optimistic again from consumer sentiment. So what's your thoughts on the whole soft landing narrative, and do you think that there's any way we could have a soft-ish landing, and if we was to have one, how would that look?
No, we're not going to get a soft landing. I think it's interesting because the first 6 months, now we're into the second half of the year now. I think when I came on your podcast last time with Graham, I was talking about how the narrative for the first half of the year was going to be inflation and interest rates. everyone's going to be terrified and petrified what we're going to do with sky high inflation, and interest rates are going to get racked up. Second half of the year, I said it was going to be all around growth and this economic deceleration, and now you're starting to see it. Everyone's talking about a recession, but the truth of the matter is, when you get in, like you were talking about all these indicators, GDP, employment, they're all backward-looking indicators. So the Fed are reacting off of 1 month lagged data. So it's it's interesting. I don't think we're going to get a softish landing. I think it's going to be a very hard landing. It's very hard to predict how the Fed are going to get out of this one, in all honesty, or how any central bank are going to get out of this one.
Yeah, it's again, looking at history, because that's all we can look at, and like you said, they even though they're looking at things that have already happened, even on those things, they're not very quick to react. They're not very reactive, right?
In all honesty, they should have. So now they're talking about going 75, 50, 50.
Yeah.
They should have started doing that at the beginning of the year, in Q1, Q2. Already they're late to react. They're in this catch-up process right now, where they're trying to catch up to inflation now, whereas they should have been doing all this in Q1 and Q2. Now they're in a bit of a muddle. So what are they going to do now?
100%. And when I look at it and think, right, we've been in a very sort of low rate environment for a long time, and to sort of the amount of QE that we did, of course, there's always consequences to playing around with markets anyway, right? Now, usually, I think we spoke about this many times, right? But to build a bit of a story around this, usually central banks have two buttons they can press. One is usually drop rates, and the other is print money.
Yeah.
The issue we have here is they've done both, exhausted both, but now we've got inflation and real inflation. Who knows what that really is, right? But we've got a higher inflation than we'd like. Now, the way I look at it is, right, they can't fully stop printing money, because once you create this beast that keeps eating the QE that we have, the economy we've built has to keep growing. It can't just stop, right? That's what they've built. So eventually they have to pull out the money printer again. But they've tried to raise rates, and regardless of whether they're doing 50 basis points, 75 basis points, whatever they're doing, raising those rates, is that really going to bring us back down to the 2% magical inflation number? Where does that need to go? And the reason why I ask this is because at what actual level interest rate does everything become insolvent?
Yeah, that's the question I think everyone's asking. At what point does everything break? And usually it's if you look at the kind of trend line of rates, the downtrend of rates over the years, it's always been like lower highs, because the debt we've kind of taken on year over year has increased massively. So we can't push rates as high as it was before. You'd think now central banks keep talking about this neutral. We're going to get to neutral. No one knows what that is. It could be, where are we at now? 1.75 roughly, yes. I think something like that.
I've lost track.
I think they want to get to around about 3.5% by the end of the year. I have no idea. Nobody knows. That's the kind of magical question. And for me, I think they've just, in the back of their heads, they've got this voice in my head anyway. Central banks have got a voice in the back of their heads telling them, "You're doing it again. You're fucking up again." Oh, sorry, I don't know if I can say this.
You're good. We're not BBC. We're good.
They have this voice in the back of their head that's saying, "You're doing it again. You're doing you're making the mistakes that central banks made in the 1970s." And I feel like that's just ringing in the back of the head, so they're just forced to keep raising these rates. But again, you got to think, raising rates calms things down from a demand side. This is a supply side problem.
Yeah.
So what do they do?
But the supply side is what created the demand. So people are saying, "Oh, this crazy demand for stuff." It's like, well, is this real demand, or is this just supply issue demand? And I think that there's a bit of both, but I think it's mainly supply side issues that's created crazy demand. And I think that when people are like, the funny thing is, like, I talk to business owners on a week-to-week basis, and some of them had an incredible 2021, and and a bad 2020 or whatever, right? And when I actually ask them, I'm like, what have you done different in 2021? Now, obviously, most of the time is because we've had crazy pent-up demand for whatever industry it is. And a lot of them are putting it down to good business acumen. And I'm like, I'm not saying that you're not good at business, but we've had a very unusual 24 months, right? And I don't think people can really put a pin on exactly what's happened altogether, and no one knew really what direction it was going. All we could do is anticipate and speculate on where it was going. Now, people are looking back at the moment and being like, look, what does this situation we're going through, if we look back in history, has this happened before? This is what everyone keeps saying, right? I don't think it has, right? But I see a few people trying to say, well, Volcker raised rates to 19% in the 80s, right? And I got a few notes here, and so when he raised rates, debt levels were low, very, very different today, and also they can only raise rates before things become insolvent. And the 75 basis point rate, the base point rate hike is the highest since 1984. But the point is, if we look back in history, a lot of the stuff that's happened today, if you actually zoomed out at the entire macro picture, what could you relate this to?
I'll be looking into this. I wouldn't compare the inflation now to the 1970s. I'd compare it to the 1940s.
Yeah.
Have you looked into that as well?
So I listened to Lynn Alden talk about it. So
Lynn Alden. There's another guy I listened to called Dario Perkins as well, his name is, and he compared it to the 1940s. So if you think about it, it was the picture now and the picture back then was very similar. So we had a financial crisis. So if you look back then, we had the financial crisis in 1929.
Yeah.
And we had the financial crisis if we come back to modern days in 2008. That catalysed almost like a depression-like state. We had the Great Depression back then, and then after the financial crisis, the whole global economy went into this like depression-like state. After that, we had World War II, 1939 to 1945. If we compare the similar event to modern times, COVID, let's just say, right? If we go back to 1939, 1945, after the war finished, everyone had all these excess savings which they'd built up because everyone during the war was told to build up your savings. So when the war kind of ended, you had all these excess savings which were just unleashed upon the economy. Same with COVID. You had all these people who handed out stimulus checks, all this excess demand unleashed upon the economy when economies reopened again. And then you look at the labour market, very similar as well. We had loads of job vacancies, but because all these people were coming back from the war who weren't very skilled, they couldn't fill the job vacancies. So it's very eerily similar. So I think going forward, one thing I'm going to keep an eye out on is the volatility of inflation. It's going to be very much like this, I think. It's not just going to be like that. I feel like it's going to be more up and down. And you're seeing it right now with commodities. Everyone's calling for recession now, and they're probably right too, because you're starting to see things like oil and copper starting to come off now pretty aggressively. So yeah, I'd rather compare it to 1940s rather than 1970s. And the fact that people are starting to say Paul Volcker this, Paul Volcker that is fucking scary, man. I'm not gonna lie.
It definitely is.
It's very scary.
Yeah, 100%. And I think that a lot of the things that they especially central bankers are commented on now, I do feel the confidence in, a lot of people didn't have much confidence in them anyway, but the general public who did look for government, central bankers to guide us through the storm. I think people are just, consumer sentiment's changing overall. So.
And I think as well, in the past, like if you look over 2010 to 2020, it was an incredible, like you said, we're no longer in this period where they can just come and save us with low rates and QE anymore. That's gone now. That decade, that extraordinary decade we had of tech growth and high beta stock growth, it's past us now, and I don't know where we go from here now. Can they still do QE in the same way they did it before? Is it going to be a new iteration of it? You've got the ECB talking about that now. They're going to introduce this new tool. No one knows what it is yet, but I have a feeling it's going to involve some sort of QE.
So I read a Lynn Alden report, and she was talking about they're going to, like you said, probably look at QE in a hidden way. So,
YCC.
And shit about using foreign exchange reserves to buy bonds and all sorts of stuff like that, increasing the FX reserves. So that's probably what's going to happen. But one of the things that I thought was interesting was I read that I'm sure it was at the Fed conference, and they talked about stable coins.
Right.
And they mentioned how stable coins could help what's currently happening, and it makes sense because stable coins are backed by US government debt and other alternatives, US alternatives, right? So I'm not sure how that's going to work because we've seen the same group of people attack stable coins. So it's going to be interesting to see how that plays out. But what's your thoughts on that? Because I've really made my mind up.
Yeah, neither have I, to be honest with you. It's not something I've generally looked into too much. I know and every time we speak, we kind of talk about it as well. But I have no view on it at the moment, to be honest with you. I'm just waiting for, obviously China have kind of started their kind of process with bringing out their kind of digital currency and things like that. But I think until the US make a move, or maybe even Europe or a major continent start making a move, I think that's when you'll start seeing something. But right now, I think it's just all It's all speculation at the moment, in my opinion.
Yeah, and I've seen that their pilot program looks like it's going to be rolled out.
What's this for the Fed?
Yeah,
Okay.
Boston, MIT would make sense, obviously, because they actually work on blockchain there. But yeah, who knows what's going to happen. But I did read that they're going to be using DLT, like distributed ledger technology, but probably not on the blockchain, which I thought was interesting, because obviously DLT can be on or off the blockchain, and apparently what they're using for their CBDC is not going to be apparently on the blockchain, which I don't know. I thought if we're going to be moving towards, blockchain technology, which they've been happy to endorse, I'm quite surprised that they're working on something that isn't blockchain based, but I suppose they can tamper with the spreadsheet more then, can't they? That's all DLT is. It's just an open spreadsheet. And we know that they like to tamper with stuff, so maybe that's it. So moving on from there, which is probably going to tie into the macro stuff anyway, is Bitcoin right now. On our last podcast with me, you and Graham, I remember when we asked you your Bitcoin end of year price prediction, I remember Graham was like, "Oh,
it was quite shocking."
And I was like, he's Bitcoin bear and all the other stuff, right? But it's the overall sort of picture isn't looking too good. Plus, the macro environment is looking very bad. So, as you know, people aren't going to be jumping into risky assets at this situation. So, what's your sort of short-term and long-term outlook for Bitcoin right now?
Short-term, nothing's really changed for me. I still think there's a long way to go for both kind of like equities and Bitcoin. The correlation is going to be pretty tight for the remainder of this year, in my opinion. But yeah, I think because we've got this now recession that we're starting to price in, I still don't think Bitcoin is going to benefit from that. I see hopefully within the next 6 to 9 months, Bitcoin can hopefully bottom out between 12 to 14k maybe. I think that'll be an incredible price to be getting in, especially for like long-term investors like ourselves. But over the long term, my kind of view has not changed. If you start looking at kind of, obviously the biggest catalyst for Bitcoin is going to be the Federal Reserve. And you can start to see already next year, there's rate cuts beginning to be priced in already for next year. Obviously we've got the halving in 2024 as well. So I think we could have almost like similar to 2018, I believe it was, when Bitcoin rallied off like 3k and everyone thought it was the next bull market. I think that tied in quite closely to where the Fed pivoted because of the repo market, if you remember. So I think we could get some sort of a rally next year in Bitcoin if the Fed does start cutting rates slightly. But then I think going into the halving, we will eventually see that larger bull market. But there is a voice inside my head saying almost whether Bitcoin's going to be tied in with the halving going forward. It just seems too for me, when anything seems too obvious, I just tend to like question it a little bit or almost disregard it. 100% it's possible that the Bitcoin could catalyze the next bull market after the halving, but I think going forward, this is something that Lynn Alden said as well, going forward I think Bitcoin's price is going to be more correlate to its supply and demand as opposed to just the halving.
Yeah, so a few things you mentioned, there's a lot down to the Fed too. We're seeing sort of more people being open-minded to it. I've seen the BIS now saying that banks can now hold 1% of their reserves in Bitcoin. So it is all interesting. One of the things before we sort of go a little bit deeper into the Bitcoin stuff, do you feel though that they're going to keep hiking rates past September? Do you think they're going to do it until next year? Because, at what point, we're already seeing a lot of economic uncertainty, and based on all that uncertainty and recession fears, and I said on the podcast previously that human behaviour is funny. We wait until we're told, general public, that we're in a recession before people start acting like they're in a recession. Strange, but they do. But at what stage do you think they're like, oh wait a minute, can we keep breaking stuff? When do you think they're going to start, loosening up on that?
I almost don't think they will until inflation comes down. Honestly, man, I feel like they've got a huge credibility problem, and the only way they're going to tackle that is by getting inflation down. I almost think if they can get inflation under, so their mandate's 2%, right? I almost think if they can get inflation under 4%, they'll pat themselves on the back and say, okay, job well done. If it stays above 4%, then they really have to start breaking stuff.
Do you feel that we're potentially entering more of like an inflationary decade? With higher
stagflationary almost, you could say. I think that's the word.
So it's something that